All right, everyone, let's get straight into it. Yesterday's U.S. market close gives us a very clear snapshot of where we are right now in this cycle, and more importantly, what kind of environment traders and investors are actually dealing with beneath the surface. This week was not about panic, and it wasn't about euphoria either. It was about reassessment. The market spent most of the week testing confidence, and Friday's close forced participants to confront whether recent expectations were still justified. The index level. The market pulled back in a way that looks modest on paper, but meaningful in context. The selling pressure was concentrated, not random. That distinction matters. When markets are truly breaking, everything sells off together. What we saw instead was targeted pressure in areas where expectations were stretched, while other parts of the market acted as relative shock absorbers. This tells us we're dealing with rotation and valuation adjustment, not systemic stress. Throughout the week, price action made one thing very clear. Leadership is narrowing. Earlier phases of the rally benefited from broad participation, where dips across many sectors were bought aggressively. This week, that behavior changed. Capital became selective. Investors stopped rewarding stories automatically and started asking harder questions about margins, sustainability, and forward visibility. That change in mindset is subtle, but it's critical. Technology remained the focal point, not because the long-term narrative has collapsed, but because it's where positioning and expectations were the most crowded. When expectations are high, the margin for error becomes very small. Even strong results are no longer enough if they don't clearly exceed what the market has already priced in. That dynamic defined much of Friday's tape. Selling wasn't emotional. It was mechanical and disciplined. Funds reduced exposure where upside appeared capped relative to risk. Semiconductors were a perfect example of this behavior. Throughout the week, rebounds were met with profit-taking rather than aggressive chasing. That tells us traders are still respecting the trend, but they're no longer comfortable paying peak multiples without confirmation. This is what late-stage momentum digestion looks like. It doesn't mean the theme is over. It means the market is demanding proof. Meanwhile, parts of the market that are less sensitive to long-duration cash flows held up better. That's not accidental. When yields move higher, even slightly, valuation math changes. Long-duration growth stocks feel that pressure first. Shorter duration, cash flow stable businesses act as relative shelters. This relationship showed up clearly in index performance and intraday flows. Rates played a quiet but powerful role all week. The bond market reminded equities that money is not free and that discount rates still matter. Equity markets can handle higher yields, but only when earnings confidence is strong and expectations are realistic. When expectations drift ahead of fundamentals, yields become a reality check. That's exactly what happened in a Friday's close. The dollar firmed modestly, reinforcing that same message. A stable to firm dollar doesn't break markets, but it does tighten conditions at the margin. It reduces the tolerance for speculation and forces investors to focus on quality. Combined with higher yields, it creates an environment where selectivity becomes the dominant strategy. Energy prices remain subdued, and that sent a mixed signal. On one hand, lower energy prices help inflation expectations and support consumers. On the other hand, persistently weak energy prices can raise questions about global demand. The market hasn't concluded that demand is collapsing, but it's no longer pricing aggressive acceleration either. This uncertainty feeds into the broader theme of caution without fear. That gold's behavior added another layer to the story. Firm gold prices alongside stable equities and contained volatility suggest investors are not panicking, but they are hedging narratives. They want flexibility. They want optionality. This is typical of a market transitioning from momentum-driven to evaluation-driven behavior point. One of the most important developments this week was market breadth. The average stock did not have an easy time. Decliners outpaced advancers, particularly on Friday. This matters because sustainable rallies require broad participation. Narrow leadership can carry indices for a while, but it also increases fragility. When only a small group of stocks is doing the heavy lifting, any disappointment in that group has an outsized impact. Volatility itself remained controlled. That's an important point to emphasize. There was no surge in panic hedging, no sign of forced liquidation. This wasn't fear-driven selling. It was positioning-driven selling. That distinction supports the idea that the market is recalibrating rather than unraveling. What does all of this mean going forward? It means the market has entered a phase where price no longer moves simply because a narrative exists. Price now needs confirmation. Pullbacks are being bought selectively, not indiscriminately. Rallies are being sold near resistance instead of chased. This is a market that rewards discipline and punishes complacency. For short-term participants, this environment favors patience. Chasing strength has become less effective. Waiting for controlled pullbacks near well-defined support has offered better risk-reward. For longer-term investors, the message is different but equally important. The primary trend is still intact, but this is no longer a set-it-and-forget-it phase. Position sizing and risk management matter more now than they did earlier in the rally. Another key takeaway from this week is sentiment. Optimism is still present, but it's no longer blind. Investors are asking tougher questions. That's healthy. Markets don't usually top when participants are cautious. They top when confidence is absolute. What we're seeing now is something closer to cautious optimism, which can extend trends but also increase volatility along the way. Going into next week, the focus should not be on headlines alone. It should be on reactions. How does the market respond to good news? How does it behave on pullbacks? Does leadership stabilize, or does pressure broaden? These answers will tell us far more than any single data point. If leadership reasserts itself and pullbacks continue to find buyers, this week will be remembered as a necessary reset. If pressure spreads and rebounds fail more consistently, the market may need more time to consolidate before the next sustained move. Right now, the market is not broken. It's being tested, and how it responds to that test will define the next phase. If you want to stay ahead of these shifts and understand how professional money is reading the tape in real time, make sure you subscribe and follow. You can also add the link below to receive real-time updates from the professor, completely free, including market insights, structural analysis, and timely commentary as conditions change.